The other thing I wanted to address with you, Ken, is when you spoke at our Meet the Masters 2 years ago, the one we had in La Jolla with Ron Paul and you and Garrett Sutton was there too, and a whole bunch of others. You talked about how one of the things I love about the real estate asset is you can buy the asset with only 20% of your own cash, for example, and then you can pull all your money out of the asset and still own it. Now,
Yeah,
in most investments, when you pull your money out, you've sold it, right? But with our asset class that we love so much, you can get your money out and still have the asset, right? And you
correct.
talked about that, and I know you demonstrated on the whiteboard and everything. But it's very similar to my refi till you die concept. And I thought I'd just ask you to share that with everybody for a moment.
I'd be happy to. So it all revolves around debt. So, OPM, I call debt OPM. A lot of
Other
people
people's
call,
money.
yeah, other people's money. Some people call that equity. I think it's both. I think that as long as you're using anybody's money, it's OPM in the form of debt or equity. But anyway, so I'll give you two examples. We just literally on Friday refinanced a property that we built 200 and some units in Tucson. We originally built it for $33 million and we raised about, I think it was close to 10 in equity and the balance in debt. So fast forward 4 years, because it takes a year to build it, a year to fill it up, a year to stabilize it. So now we're at the end of our third year. We're just going into our fourth year. We go back to the bank and we say, listen, okay, now we have this fully built property. It's got all these tenants in them. Here are all the leases. Here's the cost to run it. And here's the net operating income, which is, of course, income minus expenses. And so then the bank puts a value on that. And with that value, they gave us a $33 million loan. So now we go back and we pay off the construction loan, which was, I think, $23 million with $31 million. And we have, call it $8-9 million in excess cash. That's a cash out refinance.
Mm-hmm.
And so we took that cash and we paid back, or we'll pay next week, the investors who gave us the money originally. Now, we got about 10 million bucks, so we're not going to pay it all off, but we're going to pay most of it off. I think around 8 million of it. And so we still have like a $2 million investor balance, but we have a property that's worth somewhere in the mid 40s,
Mm-hmm.
with a $33 million loan on it. So we got 7 million in equity. We only owe 2 million on the original equity. And everybody's got their money back. And so that $8 million is actually a cash out refinance, or, it's not taxed because it's debt. So essentially people gave us their money, we gave it back, and they now can invest that again. And because it's a return of capital, it's not profit at that point. You know what I mean? And it's debt. So if it was,
in other words, there's no tax on borrowed money.
Right.
Would that be
right? That's why I kind of started with debt. So I know it's sometimes, what people do it all the time with existing apartments where they buy something for 10 million, they put some money into it, and then they grow the rents, and then they go back to the bank and they say, look what we've done with our net operating income. And they've grown it to say 17, 18 million, and they get a loan and they go back and pay back the original investment. So it's a cash out refinance, and then also the probably the biggest point is that the investors who gave us the money, they stay in the deal. So their original ownership percentage does not change. They just get their money back. So then that's what we call infinite. They have an infinite return at some point. On the deal, my Riverwalk deal in Tucson, we still owe them $2 million. That's the investor balance. So I'm, obviously still working on that, but we gave them 8 of it back. And so, so everybody's happy, right? And so they have a very small equity balance. They still have their original ownership share. And more importantly, that property still kicks off between 600,000 and 700,000 a year in cash flow,
Right.
tax-free as well, because of depreciation. I'm sure you've talked about depreciation.
Right. Yeah. Yeah. And I can do depreciation again, just for anybody who doesn't know about that. But that's phenomenal. So that's so I call it refi till you die. You call it what? Infinite return?
Infinite, yeah, we call it infinite return. It's basically getting people's money and then giving it back to them, and then everybody, living off the cash flow with no investment.
Right. Yeah. That's a pretty great deal, folks. Yeah. Don't try that in the stock market. It's just not going to work very well.
What I see, and I'm kind of aligned with Jason on these linear markets. So, for example, before the pandemic, I probably would have never flown to Cleveland, Ohio, and taken a look at multifamily. But the Cleveland Clinic is a massive employer in that area, and healthcare and medical, all that is going to just boom over this next 10-year cycle. So if you can buy there at 40 or 50,000 a unit and your rents are $1,000, it makes money. And so but you can also go to downtown Cleveland, and maybe you're not going to have which you might not have the same experience. And so rentals were pent up already. We did not have enough housing for the amount of people. That actually started in 2008. In 8, 9, 10, 11, 12, there was hardly any new construction. And a lot of those people got displaced into rental housing, which is why we had the run. So the 2008 run had exactly to do with people falling out and no new supply because lenders weren't lending. That's why we just had this run. So now that's all correcting again, but we still haven't caught up. If you go, there's a really good website, the ULI, Urban Land Institute. They have a great, really, really good comprehensive study, uli.org, on that talks about real estate trends, and you'll see that there's a massive demand for rental housing still. The question is back to these migration patterns. You can buy in a market that, like Los Angeles, and you're going to have a tough time, as an example. And so, and you're going to pay high prices, and rents are declining, and there's concessions and all that stuff. But if you can figure out where those people are going, then you'll be just fine. And so it's a market by market issue, but multifamily is here to stay. I think the government's going to come up with incentives for developers like us to build more. And that's what opportunity zones are all about.
Hey Ken, if I may, can you segment the multifamily market a little bit for us? I mean, look, at your stuff is mostly garden style apartments, right? And so I think that's okay because people can socially distance. They don't have to take an elevator in your properties, right? But some of these apartments are just not going to fare so well because of the social distancing problem, right?
I agree with that. Yeah. So we have, we actually do have properties with elevators. And
well, I mean, they might have them, but they're only like 4-story, 3-story.
Yeah, right.
They can walk.
Yeah. Well, there's no question that people are concerned about. There's no cure for the virus at the moment, and people are freaking out around, all of those kinds of things. And, so we're definitely going to see more movement to the urban, and in the urban areas, you have height density issues. So you have density issues and height issues. So what happens in downtown cores is because land's so expensive, the only way to make a deal work is you have to go up. That's the only way it can work. So you might pay $3 or $4 million for 1 acre, maybe even 10, and you have to go 12, 15, 20 floors. And that's why it's so expensive. That's a whole different ballgame. Well, those folks, you're going to start to see to these garden apartments. They're going to move a little bit further out. They're going to save on rent, and they're going to have naturally social distancing. That's already happening. I'm not going to use Cleveland because I'm not there right now, but I can use Phoenix, and I can use some of the other markets that we're in, like Dallas. You know, there's a very big difference between downtown Phoenix and 1 mile from there, massively different. And then 2 miles from there, and then 5 miles from there, and where you start to get into other cities, even Tempe, Mesa, Scottsdale, for example. And those submarkets are very unique and very, very driven based on the demographics of what's happening in that submarket for schools, housing prices, property taxes, which we haven't talked a lot about. And all of that stuff is going to have movement. And so, for example, this is not hypothetical, but I think the governments are going to start going after us for property taxes. Personally, I think that's how they're going to have to pay for it. If you Google right now, Nashville property tax increase, you'll see that they increased, not proposed, a 34% increase in property taxes for Nashville. So I talked to my friend who's doing multifamily out there, and he's like, it's killing us, right? Because it was underwritten on a model that they had. And so as a multifamily guy, you know, I'm taking a look at, you know, the drivers of employment. So there's a lot of focus on businesses going out, restaurants and hospitality and businesses and all that kind of stuff, and hotels and all those kinds of things going down. But I think you got to focus on the ones that aren't. And so, you know, let's take a look at home improvement, gaming, pet products, gardening, home beauty, home fitness, home health, you know, medical, liquor sales, grocery stores, you know, all those places, all those things are doing really, really, really well. And so, and then there's industry around that. And so if you can focus on areas that are thriving at the moment, you're going to find companies that are growing. My friend here in Idaho, of all things, is in the pet business. He does pet products and pet crates and things like that. He just hired 50 more people. Now, this is a small little town. That's a big hire for a small little business. And he told me that his sales have doubled because people are home with their pets and they are buying crates and all these kinds of things. And so now, of course, because I'm here, I'm looking at land around, you know, because now rents are high here and they're growing here and occupancy's high here. Small little linear submarket that no one on the map even really takes a look at. But it can be quite the opposite too, as you start to look at areas that have massive fallout. So for me, I would look for housing around hospitals that are well anchored and well capitalized, and you know, anything around, you know, just look at, as you know, as Jason knows, I love Buckminster Fuller. If you guys haven't studied him, he was a futurist. He died in the 80s. He had one quote that I use all the time. It says, don't fight the forces, use them. So, you know, with this COVID stuff, it's accelerating things. You know, retail is going down, malls are going down, commercial office at Class A is downsizing. Those are going to happen no matter what you say, no matter what Guru says. You know, that is all happening. People are moving out of the city core right now. So now your job is to figure out where they're heading, and that's the big puzzle. And once you find a little market that you're really happy about, man, just go to town. That's what I do. You know, that's what I did in Frisco, Texas. I did that in Plano. I did that in Carrollton. I did that in Richardson, which is north of Dallas. You know, back in the late 90s, and I did that in Austin, and I did that in areas all over Texas. And so, you know, and it's all based on those trends, you know, as things kind of ebb and flow. And so that's how we pick site selection for new construction. That's how we pick properties. I don't want to be a pioneer. I want to be in the path of growth. I want to look at the trends, and I want to be there as it progresses. I want to be part of that. I don't want to create it.